Hey everyone, it's Ajar. Welcome back to the channel. Today, we're diving into the world of investments. We're talking about how to make your money work for you, so you can build real wealth and achieve financial freedom. Whether you're a seasoned investor with a portfolio full of dividend stocks and real estate, or you're just starting out and don't know the difference between a Roth IRA and a 401k, this video is for you. Look, understanding different investment strategies is crucial, no matter where you are in your journey. That's because the name of the game in investing is to minimize risk while maximizing returns, and that's exactly what we're going to cover today. I'm going to break down 5 popular investment strategies, explaining exactly how they work, the pros and cons of each, and how you can start implementing them today. We're going to keep things super clear and actionable, so you can walk away with real knowledge that can help you make smarter financial decisions. So grab your notebooks, let's get started. Alright, let's kick things off with diversification. You've probably heard the saying, don't put all your eggs in one basket, right? Well, in the investing world, that's diversification 101. Think about it like this. Let's say you invest your entire savings in a single stock, even if it's Apple or Tesla. What happens if that company faces an unexpected downturn? Your entire investment takes a hit. Not good, right? That's why diversification is so crucial. Diversification is all about spreading your investments across different asset classes like stocks, bonds, real estate, maybe even a little bit of gold. Think of these as different baskets for your eggs, and within each basket, you can diversify even further. For example, within stocks, you can invest in different sectors like technology, healthcare, energy, and real estate. You can also invest in different countries. Emerging markets like India or Vietnam might offer completely different growth potential than, say, the US market. By diversifying, you're essentially creating a safety net for your portfolio. If one investment takes a hit, the others can help cushion the blow. It's like having a backup plan, or even multiple backup plans for your money. Now, you might be thinking, doesn't this make investing more complicated? And yeah, it can seem that way at first. But here's the good news. You don't need to be a financial expert to diversify effectively. There are tons of resources available like robo-advisors or target date funds that can help you build a diversified portfolio with minimal effort. You tell them your risk tolerance, your time horizon, and they handle the rest. The key takeaway here is that diversification helps you manage risk. It's not about trying to time the market or pick the next hot stock. It's about building a resilient portfolio that can withstand market fluctuations. Remember, slow and steady wins the race, and diversification is the tortoise in the investing world. Now, let's talk about value investing, one of my favorite investment strategies. This is the Warren Buffett approach to investing, where you're basically looking for hidden gems in the market. Companies that are undervalued by the market but have strong fundamentals and long-term growth potential. Think of it like this. You're at a flea market or thrift store and you find a vintage Rolex watch for a fraction of its real value. That's what value investing is all about, finding those diamonds in the rough. Value investors spend their time analyzing companies, looking at their financial statements, their management team, their competitive advantages, and they try to determine the intrinsic value of the business. If the market price is significantly lower than their estimate of the intrinsic value, that's when they get excited. Now, value investing takes patience. You're not going to get rich quick with this strategy, but if you're willing to put in the time and research, and wait for the market to recognize the true value of your investments, it can be extremely rewarding. One of the biggest advantages of value investing is that it tends to be less volatile than other strategies like growth investing, which we'll discuss next. That's because value investors are looking for companies that are already profitable and have a proven track record. They're not betting on high-growth, high-risk companies. They're looking for stability, consistency, and a margin of safety. Of course, no investment is completely risk-free. Even the most undervalued company can face unexpected challenges. But by focusing on companies with strong fundamentals, value investors aim to minimize their downside risk while maximizing their upside potential. They're playing the long game, and they're in it for the long haul. Chapter 3. Growth Investing, Riding the Wave of Innovation. Now let's switch gears and talk about growth investing. This strategy is all about finding companies that are on the cutting edge of innovation, the ones disrupting industries and growing at a rapid pace. We're talking about companies like Tesla, Square, Zoom, or even the next big thing that no one's heard of yet. Growth investors are looking for companies that are reinvesting heavily in research and development, expanding into new markets, and grabbing market share. These companies are typically not focused on profits in the short term. Instead, they're all about growth, growth, growth. Now, growth investing can be incredibly exciting. You have the potential to achieve those massive returns that everyone dreams of. But it's also important to understand that growth investing comes with a higher risk tolerance. These companies are often unprofitable, their valuations can be sky high, and they can be much more volatile than more established businesses. Think about the dot-com bubble in the late 90s. A lot of investors poured money into tech companies, many of which were overvalued and ultimately failed. But for those who invested in the Amazons and Googles of the world, the returns were astronomical. So how do you find these potential winners? Well, it takes a lot of research and due diligence. You need to understand the industry, the company's competitive landscape, and their management team. Look for companies with a strong track record of innovation, a clear vision for the future, and a large addressable market. You're essentially trying to predict the future, which is never easy. But if you can identify those companies that are truly revolutionizing their industries, the potential rewards can be significant. Just remember, growth investing is a long-term game. It's not for the faint of heart, and it's essential to diversify your portfolio and not put all your eggs in one basket. Chapter 4. Income Investing. Generating a steady stream of cash flow. Let's move on to income investing, a strategy that's all about generating a steady stream of passive income from your investments. This is perfect for those who are looking for regular cash flow, whether it's to supplement their income saved for retirement, or just have more financial security. Now, when it comes to income investing, there are a few key players. First up, we have dividend stocks. These are stocks that pay out a portion of their profits to shareholders on a regular basis, typically quarterly. Think of it like getting paid to own a piece of a company. Then, we have bonds. When you invest in bonds, you're essentially lending money to a government or corporation, and in return, they pay you interest payments, usually twice a year. Bonds are generally considered less risky than stocks, making them a popular choice for investors looking for a more stable income stream. And finally, we have real estate investment trusts, or REITs. REITs allow you to invest in income-producing real estate without actually having to buy, manage, or finance properties yourself. They typically own and operate things like shopping malls, apartment buildings, or office spaces, and they distribute a large portion of their rental income to shareholders as dividends. Now, income investing can be a great way to build wealth over time while also generating passive income. It's particularly appealing to retirees or those nearing retirement who are looking for a reliable source of income that's not dependent on a 9-to-5 job. But it's important to remember that income investing is not without its risks. Dividend payments are not guaranteed, bond prices can fluctuate, and REITs can be affected by changes in the real estate market. Overall, income investing can be a valuable addition to any diversified portfolio, but it's important to do your research, understand the risks involved, and choose investments that align with your individual financial goals and risk tolerance. Chapter 5. Socially Responsible Investing, Making Money While Making a Difference. Last but not least, let's talk about socially responsible investing, or SRI for short. This strategy is all about aligning your investments with your values. It's about making money while also making a positive impact on the world. Now, SRI has exploded in popularity in recent years, as more and more investors are looking for ways to support companies that are addressing social and environmental challenges. And the great thing about SRI is that it's not just about feeling good, it can also be financially rewarding. So how does SRI work? Well, SRI investors use a variety of strategies to build their portfolios. One approach is to invest in companies that are considered leaders in environmental, social, and governance, or ESG, factors. These are companies that are committed to sustainability, social justice, and ethical business practices. Think of companies like Patagonia, Tesla, or Unilever, companies that are actively working to reduce their carbon footprint, promote diversity and inclusion, or support fair labor practices. Another approach is to invest in specific themes or causes that you care about. For example, if you're passionate about clean energy, you could invest in companies that are developing solar, wind, or other renewable energy technologies. Or if you're concerned about access to clean water, you could invest in companies that are working on water purification or conservation solutions. The point is, SRI allows you to tailor your investments to your values and make a real difference in the world. Now, one of the biggest misconceptions about SRI is that it means sacrificing returns. But that's simply not true. In fact, numerous studies have shown that SRI funds often perform on par with or even outperform traditional investment funds. So, if you're looking for a way to invest your money in a way that aligns with your values and makes a positive impact on the world, SRI might be the perfect strategy for you. It's a win-win situation. You get to grow your wealth while also supporting companies that are making the world a better place. Outro. Start investing smarter today. There you have it, 5 different investment strategies to consider for your portfolio. We covered diversification, value investing, growth investing, income investing, and socially responsible investing. Each strategy has its own unique set of advantages and disadvantages, so it's important to carefully consider your individual financial goals, your risk tolerance, and your time horizon before making any investment decisions. Remember, the best investment strategy is the one that aligns with your personal circumstances and helps you achieve your financial objectives. And as always, it's crucial to do your own research, consult with a financial advisor if needed, and never invest more than you can afford to lose. Please like, share, and subscribe to our channel for more investment tips and strategies. And hit the notification bell so you don't miss out on any future videos about building wealth, achieving financial freedom, and living your best life. Until next time, happy investing.